lakini most of zingine the last session tulikuwa nayo,
Yes.
at least they were covered. Ndio hiyo
Okay.
Margaret ameingia.
Nini malizia, ukimaliza kupea nini mtoto operation. Sawa nia, I need you to take this thing and harakisha, I need you in bed right now in 20 minutes.
Hey, Margaret. Boy.
Yes.
Habari yako?
Njema, labda ya nini?
Nasikia unapanga kwako.
Sorry for that. Nilisahau kumute.
Oh.
Lazima watoto wapangwe na kila kitu.
Sawa, karibu sana.
Asante.
Hi, Margaret.
Yes, I'm fine. How are you?
I'm also fine.
Okay.
Yeah, karibu.
Asante. Good to hear from you.
So can you maybe start, what is your opinion? Guys, did you proceed?
No.
We can proceed. Maggie, hi.
Hi. How are you?
Fine.
At least today you are punctual. I hope your network is okay. I think we can proceed.
Zach.
Yes.
I think nilikuwa na swali. I had a question. Lakini ukifungua nitaiona. Utakumbuka. Kuna swali nili postpone last time.
Yeah.
I think it will come on the way.
Okay, fine. I think.
So Zachary.
Yes.
Now that we have been dealing with examples of a company.
Yes.
Would you use the same formula to do a report for a sole proprietor?
Okay, there are a few adjustments that you need.
Okay.
Okay, fine. The first, just a few adjustments. Maybe if you go to the balance sheet, for example, you see, of course, for the balance sheet, the responsibility of who are charged, the responsibility of the financial statement, the directors, right? Yes. So, of course, in this case, you see a sole proprietor has no director. I mean, it's the entrepreneur. So there are a few adjustments. Okay, the presentation-wise, for example, like the way we have the balance sheet here, the only difference I can say here is the case of equity, because in here we call proprietors capital, not share capital, the way we are used to. But the other sections, PPE, that's the assets, liabilities, those are the same. Now, also sorry?
Go on.
Yeah, for the SOE part, we don't have this SOE because this is changes in equity, and of course, equity is share capital. We usually present what we call a proprietor's account. Okay. So again, there's a slight difference. We can cover that in future, maybe just to show the differences. But majorly, in terms of linking, the way you prepare an Excel balance, then you link to the notes, then you link to the financials. There are just a few adjustments. Cases whereby when you are doing your financials, you have now to consider this is for a sole proprietor, not a company. Then the other issue in report, actually I did the audit, I added the audit pages. You can see them, these are AUD, AUD1, and AUD2. So those are the auditor pages, there are 3 pages. So for example, if you go to the last page here, in terms of the audit, you see as required by the Companies Act 2015, because it's the one that regulates the companies.
Zach, can you please maybe enlarge a bit?
Oh, yeah. Sorry.
I'm also using my phone, so
yeah. How is that? Should I zoom in further? Or?
Still enough?
Not yet.
I guess that is okay.
Yeah, that's
Maggie,
okay.
Okay.
That's okay now.
That's okay, fine. Okay. So as you can see here, we are saying as required by the Companies Act. Of course, for an entrepreneur, for a sole proprietor, this is not a requirement because they are not regulated by the Companies Act.
Okay.
But in terms of like giving the information here, you see, it's majorly the same thing. So there are just a few adjustments that you make, but not major adjustments really.
Okay.
Yeah.
And for the sole proprietor, does he or she also have to provide with everything, the trial balance first, and then you do the financial statements? Just like the company.
Now let's understand first for the trial balance is derived. It's a derived report, right? And it's derived from your financial transactions or whatever you have been doing. So whether you are a sole proprietor, a partnership, a company, either way, when you do your transactions, one of the reports that you get, especially if you are using a system, is the trial balance. So they still have to provide, unless you are dealing with a case of incomplete record, because maybe for most sole proprietors may not necessarily be keeping good books or the appropriate books. So you may have to derive now your trial balance. But either way, for you to do this case, the starting point is always, whether you have complete or incomplete records, the starting point is always the trial balance. Yeah.
So Zach,
Yes, David.
what about those people who do use software and stuff on the trial balance? You use the ones they generate, or they do have some data somewhere else.
By software, you mean like they are using the software to do accounting?
Like let's say QuickBook.
Yeah.
So
QuickBooks. Sorry.
do they
Go
have
ahead.
those things like trial balance that is automatically generated? Or they also do have to do some external work to trial balance.
No. You see, one of the key things about automation, if you're using a software, is that one of the key reports that a good software, if you may say so, should have a trial balance. Actually, I've never come across any software, any accounting software that doesn't offer you a trial balance. It's one of the standard reports. Okay? Because anyway, I mean, if you don't give that report, maybe the clients may be like, we need us an advanced software which can be able to generate such reports. Actually, if you look at the client TB here that I shared with you, it would be an assumption that the format that this is in is the same format that you could actually have extracted from a software.
Okay. Yeah.
So it just simplifies the work for you if you're using a software.
Okay. So any software should have this, like the presentation must be the same, or it can be different. The same.
Okay, basically what happens, for example, like there's a software called Tally, and I suppose probably QuickBooks has also those configurations. You can configure maybe, for example, if you're extracting a trial balance, you may decide, I just want the net transactions, I don't want the opening balance or the closing balances. But the standard format is this. But of course, there's that configuration where you can specify. Now, depending on the software, you may have advanced configurations, maybe some that even allow you to split into the sections that relate to the, only give me the ledgers that are related to the profit and loss, or ledgers that are related to the balance sheet. Those are additional configurations, but the standard format is this.
Okay.
Yeah, it depends on the software. Now that's, yeah. Is there any other question, or we proceed now? Okay, fine. Maybe we can proceed now with the financials. I think last time we covered up to the balance sheet, which balanced. The bottom line was the same. So we have that. I think the TC, have you finished this tax computation and confirm? Yeah, so we did those. Tax note. Outstanding tax 1.7, that should go to the balance sheet. Okay, fine. So I think we can now proceed to the cash flow. Now remember that I said that for audit purposes, we usually do the indirect method. There's usually the direct method and the indirect method. With the indirect method is where we reconcile the profit to the items that are, of course, we make some adjustments and then we reconcile this to the cash. But for the direct method is where you have to do your own computations, like you assess your suppliers, you assess the data. It's a bit complex, but majorly, unless you are doing maybe for accounting purposes, which maybe may require this because of the internal reporting. But for audit purposes, basically what we are doing is just a reconciliation of the profit to the cash. So here, this one I can change to profit because it's a profit. Now we get this is before tax, okay? So we get this figure from our income statement. This is the profit before tax, so 7.9. Then we now start making some adjustments. Now, the items that we usually adjust here are those either incomes or expenses that do not relate to cash, or there was no cash transaction, cash movement for that transaction. Example would be depreciation. So you charge depreciation before determining your profit before tax, but there was no cash item in depreciation. Then a revenue would be, for example, say that you did a revaluation and you ended up with a revaluation surplus. Now that is treated as an income, but there was no actual cash movement. So for the expenses that you incurred, but there was no item that or any cash movement, then you have to add it back. Okay. But then for the incomes, you have to less them. Any income that, of course, is not cash related. So we get the depreciation amount. We can get this from 97. So that is 1.1. Then trade and other receivables. Okay. Trade and other receivables. Now, if you go to the balance sheet, so usually what you consider for this case is quite straightforward because there was no previous year. But usually, maybe one of the accounts that we may be doing later is going to involve movement or comparative figures from the previous year. Now, what you usually consider is when it comes to receivables, you have to ask yourself the question of, did they increase or decrease? Now, if your receivables increased, right, we treat that as, if your receivables decrease, it means they are paying, which means it's a cash in to the company. If they decrease, on the other hand, now, although there is no cash movement, cash going out, we treated the opposite. In other words, we assume that cash went out. Because in essence, it's like you give them, of course, by selling goods on credit, it's like you give them cash. But for this case now, of course, there's just one figure, and there are no comparatives. So we ask ourselves, what is the impact of this to our cash? It's like you give them cash because, of course, they increased. There was no previous comparison. So this one you have to less it because it's a cash outflow. Okay. Confirm there's a. Yeah. Now from there we go to trade and other payables. So trade and other payables again they increased. Okay. So for this case, increasing trade and other payables, it's like the supplier gave you cash. Of course, the easier one to understand is where your supply is your trade payables are decreasing, meaning you are paying them out, you are giving them cash. If they increase, it's like the credit that you're being given by the supplier is like giving you cash. So for purposes of cash flow analysis. So in this case, you are going to add it because this is a cash in. So we go to the balance sheet. And then we get this figure, 900,000. Okay. Now from there, we have to adjust the next section, the tax that was paid. Now note this is the tax paid, not the tax for the period. This is the actual cash payment. Remember that we got this, we can actually even get it from the notes. So if I say, I go to note 8, I can look for the installment tax that was paid. It was, this one, 700,000. And because it's a payment, it means it's a cash leaving the company. Okay. Now, once we do this, then we can now come up with net transactions that have been generated from operating activities, which of course majorly involves the changes in your working capital. So if I just sum this, so your changes in working capital, the cash associated with this is 5 million. Okay. Then we now go to the investing part, which majorly involves asset movement. In this case, we only bought assets. We never disposed anything, meaning by buying, we were giving out cash. Cash was leaving the company, and therefore we have to less that figure. So if we go to NT9, we can get the total assets that were purchased during that period. So, and this is the additions. So the total amount is 4.7. Now from that part, this one you can just, because it's just the summation, so it's one item, you just take that. Then there's now cash flow from financing activities. Okay. Now, financing activities may fall into various categories. Issue of shares is one of the things. So this one you can just get the figure from, that would be a note 10 or note 8, 98. So this is the amount, 100,000, okay? And because we issued shares, it means people subscribed. In this case, of course, the directors were the same as the owners of the company because it's a private company. So they gave the company money because remember that the company is a separate legal entity. But that is not all now. Remember that we have a bank loan, okay, which is also a financing item. So we can just insert like 2 rows here. So here we can say changes or loan movement, maybe I just call it loan movement. Now we go to our balance sheet and ask ourselves, so what happened to the loan? So you can see now we have a loan of 1.4 that is still outstanding. Now remember that this case of loan, right? Loan is money that is coming into the company, okay? Therefore, this amount 1.4 needs to be an increase in cash. So if you go to the cash flow, then loan movement becomes an increase or a positive. So we get the figure 1.7, 1.4, sorry. That